In this video, we're going to talk about Bionano Genomics, trading under the ticker symbol Bngo. Before today's video begins, just a quick heads up that not all my videos are made on the same day they're posted, so if there are material events that happen afterwards, I will make a follow-up video to reflect those changes if need be. With that being said, let's go on to today's video. Bionano Genomics is a startup operating in the genomics sector and has been a popular stock to pick and a topic of conversation ever since late 2020, after the company managed to develop tests that are better and more affordable than its rivals. This was mentioned in scientific magazines and then picked up by ARK Invest, managed by Cathie Wood. This was a really major event for the stock because it attracted the attention of retail traders. Its appeal is the fact that Bionano Genomics seems to have a lead in the sector, and that sector itself is considered to be on the road of becoming a lot more significant in the years to come. Looking at the Bionano Genomics operations, fundamentally the news have been positive and bullish for the company. On December 29th, Bionano Genomics published an article stating that they have developed a prototype for their single-molecule imaging system. This system is 4 times more powerful than their current one, Sapphire. Towards the end of 2021 as well, a prominent analyst has predicted that Bionano Genomics may start to have significant operating revenue around Q4 of 2022. Given the progress of different events over time, especially in Europe, as many labs in Belgium, Germany, and Spain are now applying for medical accreditation and recognition, which may increase the exposure of genomic treatments and increase of adoption of Bionano genomic tests. Market participants are attracted by the company because its technology and business model seems to be head and shoulders above the competitors, and it has very high brand recognition. This is why I think that in the long term, market participants who bought its shares in the first place are going to be rewarded, because things are, fundamentally speaking, encouraging for Bionano Genomics. Now, with that being said, it is one thing to put a positive diagnostic on the company. It's quite another regarding whether we should buy its shares now. As we know, the stock has been falling for quite some time now, and falling significantly. And there is no sign that it'll slow down anytime soon. Let's also take a look at the technicals of Bionano Genomics. The trading volume of the company has recently been 11.5 million shares, compared to the average volume of 9.3 million shares a day. Over the previous 52-week period, its price fluctuated between $1.81 and $15.69. The market cap of Bionano Genomics is currently at $587 million, compared to an enterprise value of $1.2 billion. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability, attractiveness, and even solvency. One key element to note regarding the enterprise value here is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than the competitors, partially because it has a good management, stronger brand recognition, bigger following online, and other elements as such. It is basically what is unique about this company in particular compared to an alternative competitor. In other words, it's not a tangible asset that companies can use. However, it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value the market gives to its assets when the debts are paid off. In case the company goes to liquidation, goodwill would be completely depreciated in the first place, and we would be left with potentially less assets to distribute to shareholders and debt holders than the figures shown on balance sheet as we currently speak. In comparison to its historical price fluctuations, the stock is 12.2% higher than the 1-month low, 12.2% higher than the 3-month low, and 12.2% higher than the 52-week low. On the options market, which often gives a hint on a market sentiment on where the stock price is likely going to head toward, the implied volatility is 124%, compared to a historical volatility of 65.3%. The put-call volume ratio is currently at 0.16. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, because many institutional investors choose to hedge their exposure by buying put options. The most recent volume of options traded has been 2.6 thousand contracts within a day, compared to the 30-day average of 5.2 thousand. In terms of open interest, the most recent volume of open interest has been 113,000 contracts, compared to the 30-day average of 149,000 contracts. Regarding the shareholder structure, institutional shareholders hold about 27% of all outstanding shares. The biggest shareholders include Vanguard, State Street, and Julius Baer. Understanding shareholder structure is relevant to an extent because it helps to determine whether you should hold a stock long-term or to view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust for shareholders. Usually, the consensus is that there should be about 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, since many titles are mostly held by retail investors and not institutional investors. But that tends to be the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total float, it can be a sign that there's an organized shorting operation that is happening, like what happened with GameStop, AMC, Ethereum, BBIG, and so on. The current short interest is 13.3% of the total float and 43.2% of the dark pool transactions. Let's also take a look at the indicators. Financial indicators do give us a suggestion of what the price movements are showing, at least in the short term. The oscillators are showing 2 sell, 7 neutral, and 2 buys, with an overall tendency of neutral. The moving averages of the past price action show 13 sell, 1 neutral, and 1 buy. The overall tendency from the perspective of moving averages is the strong sell. Keep in mind that the indicators often show what the present and the past performances of the stock are, but rarely predicts accurately the future. Nevertheless, they are relevant to determine if the timing of the trade is the right one. Regarding the pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $2.15, $2.59, and $2.86. For the resistance levels, they are $3.72, $4.45, and $5.60. My opinion on the company remains overall worthy of your time, and that it deserves to remain on your watch list and eventually in your portfolio if you're future-oriented. With that being said, keep in mind that the future may occur a very long time from now, and that you should make sure that your portfolio is hedged against the medium-term volatility risk. My recommendation is to make sure that your exposure of Bionano Genomics remains at a maximum of 0.5 to 1% of your portfolio, and to look for other potential support levels to enter in the trade. The holding period should be between 6 to 12 months after you own it, and this should only happen after some support being identified. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.